Page 1 of 7. Page 2 of 7. Introduction to business. Explore the different formation options for a business. Page 3 of 7. 1. Sole proprietorship. Think of sole proprietorships as the easy button of business formations. You simply start doing business under your own name. Some states may require you to have a business license or a local permit, depending on your type of business, but there aren't any filing requirements beyond those. Because sole proprietorships are so easy to start, they're traditionally the most popular type of business. According to the Small Business Administration, more than 70% of businesses in the U.S. are sole proprietorships. As a sole proprietorship, you don't have any liability protection. That means your personal assets can be used to satisfy a business debt or legal judgment. Page 4 of 7. 2. Partnership. From both a paperwork and operations standpoint, partnerships are straightforward. States don't require specific partnership documents, but it's a good idea to create a partnership agreement that's reviewed and signed by all participating partners. When opting to establish a partnership, you have 3 options. General, this is your basic partnership, as detailed above. Although paperwork and filing requirements are minimal, you should check with state and local regulations to see if you need any licenses or permits to operate. Limited. Think of a limited partnership as a general partnership with limited liability protection. To create a limited partnership, one partner is designated a general partner with unlimited liability. Then, other partners are limited partners, which means their liability is the same as their investment. These limited partners are typically silent partners. They invest in the business but don't involve themselves in day-to-day operations. Limited partnerships are pass-through tax entities, so taxes are paid at the individual level. Joint ventures, these are formed by 2 or more people who are working on a single project. As a result, they're typically more limited in scope and length of time than a partnership, which may continue indefinitely. According to Nalo.com, the necessary elements of a joint venture include an express or implied agreement, a common purpose that the group intends to carry out, shared profits and losses, and each member's equal voice in controlling the project. Additionally, joint ventures are treated differently when it comes to taxes. Partnerships are pass-through tax entities, while joint ventures can be taxed as a corporation or a partnership. Page 5 of 7. 3. Limited Liability Company, LLC. As David Ingram wrote for LegalZoom, limited liability companies combine the advantages and disadvantages of corporations and private partnerships. In an LLC, business owners referred to as members aren't personally liable for business debts or legal judgments. So, when you open a business bank account or take on a debt, the LLC is responsible for it, not the individual members. Additionally, LLC members have the flexibility to decide if they want to be taxed as a partnership or a corporation, unless your LLC has only one member. Then, the LLC is taxed as a sole proprietor. There's no limit to the number of members your LLC can have, but LLCs can't issue stock. LLCs do, however, have significant flexibility when it comes to deciding how to allocate profits and losses, which is defined in an LLC's operating agreement. LLCs require some setup, but if you're forming a simple LLC, this can usually be completed for a few $100s. Be sure to check with your state first, which may have standards of LLC formation that will guide your next steps. Page 6 of 7. 4. Corporation. And that brings us to corporations, which are the most complex and expensive of your business formation options. 2 types of corporations exist, C corporations and S corporations. C corporations are considered the default because they have fewer requirements. However, S corporations typically save on taxes because they're treated like a sole proprietorship. The profits, or losses, are passed through the S corp to the shareholders, and are only taxed to the shareholders and reported on their personal tax returns, wrote Edward A. Heyman, ESQ, for LegalZoom. Both types of corporations have a lot in common. To create one, you file articles of incorporation with your state's Secretary of State. Corporations are required to have elected directors, typically chosen from among a corporation's owners or shareholders, and you may have to include these names in your paperwork. Once the corporation is running, profits or dividends are distributed to shareholders according to the number of shares they each own. Additionally, corporation owners have limited personal liability protection because the corporation is considered a separate entity from the owners. C and S Corp are required to do the following: issue stock, adopt bylaws, hold annual director and shareholder meetings, maintain meeting minutes, issue written resolutions for any significant decision, file annual reports with state government, pay annual fees. And regardless of which type of corporation you choose, you'll want to be sure to obtain applicable permits and licenses, register with the IRS, state and local tax agencies, and open a corporate bank account. Page 2 of 2. For more details, contact us. +92 336 590 9194. Director at icpstudies.com.pk. Main Kumra Road, near Medicare Hospital, Ladakh City, Pakistan.